And you talk very frequently to Bloomberg about this process of bottoming out for equities, at least. The hope that earnings would ultimately help stabilize that process. Is that what we're looking at here for equities more broadly?
What we've seen here the past several weeks, right? I mean, if you go back to what caused this correction initially, it was a technical condition in that there was the fundamental concern of higher interest rates coupled with margin compression at some point in the future. That started a little bit of selling pressure. Then the technicals took over with systematic trend followers selling and vol products blowing up. And then we started the bottom. And then you had the trade war talk heat up, which caused another leg down. And it looks like what's happened here the past several weeks is you've started to see a bottoming process. You've seen earnings come through. Even in cases where stocks have sold off post-earnings announcement, the earnings have been strong. And so we always go back to, did we peak in January this year in terms of the bull market? The answer is almost unequivocally no, right? Because this cycle should go on at least until early 2020 in terms of an economic cycle, which means by definition, we're going to reach higher highs at some point, more than likely later this year.
What did you learn from the earnings that we've gotten so far, particularly the banks, that leads you to believe that earnings growth will continue and that'll drive stocks to new highs? Yeah,
so if you look at banks in particular, even though earnings have been strong, there's been a little bit of disappointment in terms of net interest margin, particularly for the larger banks themselves. And some of that has to do with what Julie was mentioning before in terms of the flattening yield curve, but it also has to do with, loan growth has still not been as robust as many people expected. And the only answer we can offer there, because we compare the large banks to the regionals, regional loan growth has been better and community loan growth has been even stronger, is capital markets are still wide open. So, if you're a larger or middle market or larger company, you can access financing through capital markets, which does lead to underwriting fees, but certainly doesn't lead to organic loan growth and stronger net interest margin.
So if we're talking about, even for some of the smaller and the community banks, because I know this is where you're focusing, if you're an equity investor right now, you still want that loan growth. You're fixated on the net interest margin. And yet, if you look at where you see better opportunity and better value, which is some of the hybrid debt side, then you can worry less. Yeah,
well, so, if banks do well, both equity and junior debt securities should do fine. However, there's less downside to the hybrid debt instruments if something goes wrong. You don't need prices to go up because you have healthy cash flow that's improving. And on loan growth, I mean, equity investors are obsessed with this because this is what they need to justify higher prices and valuations over time. But if you're a creditor, you'd actually like to see lower loan growth, with the loan growth being very rational, as opposed to excessively high loan growth, where a lot of the underwriting standards are deteriorating.
Just want the quality of
You want the quality. You'd rather less quantity, high quality, than a big boost in quantity, but deteriorating quality.